Thank you for joining me for my June 2025 market update and outlook. My name is Liz Whittaberry, and I'm the founder of Best Path Advisors here in Colleyville, Texas. And I do comprehensive retirement planning, which means that I create retirement income plans, help minimize lifetime income taxes, help make gifting and legacy plans, protect against risk, and invest in retirement assets to line up with the plan. And so today I want to talk about what I see as far as the market and the economy, what we could expect for S&P 500 earnings going forward, and what you should focus on for your retirement plan right now. I'm going to run through 15 slides, and if stick with me to the end for the what you should focus on right now. I want to start though by talking about this volatility that we've seen recently. When the tariffs were announced at much higher rates than anyone expected, then the markets reacted negatively very quickly. And as those tariffs continued to increase, then the bond markets began to react very negatively as well. And at that point, the White House backed off a bit. And then the market rebounded. And so we have this very positive 27-day return, this strong rally, one of the strongest that we've had since 1950. Now, if it continues to go as it has in the past, then we could see very strong returns going forward the next 1 year, 2 year, 3 year, 4 year, 5 year, and so forth. We could see positive returns going forward. And the market does have a positive return more often than not. But this time is different. Of course, every time is different. There's something different that is causing the angst and the pain at that point in time. And this time, it's the fact that we've got these tariffs that are higher than they've been since the 1940s. And they were even higher, which is what was causing so much angst at that point in time. And now that they've backed off, they're at this higher than the 1940s rate. We want to pause for a minute and just say, well, what is the reason for these tariffs? Why are they at this level? Remember when Treasury Secretary Scott Bessent was confirmed, he gave 3 reasons. One is that they want to bring manufacturing back to the U.S. Second, they want to raise revenues to provide the funds to extend the Tax Cuts and Jobs Act, which is going to expire at the end of 2025. Now, that is being worked on right now. The bill is called the One Big Beautiful Bill, and it's working its way through the process of becoming a bill that would make permanent a lot of those tax cuts that are in the Tax Cuts and Jobs Act. The third reason is to have a lever to use in negotiations with other countries. Now, the wild card is how those other countries are going to respond to the tariffs and what the second order impacts are. And so I want to point out some research that was done by Bridgewater. Bridgewater was founded by Ray Dalio. He has since moved on and retired, but he was head of that company for decades. And he's written some books on the big debt cycle and the changing world order. This research is along that lines, looking at going from this free trade environment to what they're calling modern mercantilism. Now, in the free trade environment, we saw very strong U.S. growth. We had a Fed that was very flexible and proactive and that raised or lowered rates in order to keep employment and inflation at the levels that they were targeting. Our U.S. companies were dominant on the global scene, dominated that global scene. And then we had a lot of global capital surplus that flowed into the U.S. as investments, and that helped boost our GDP. Going forward, it's possible that these tariffs and the changes that are occurring in the global scene are going to create this policy-induced slowdown in our growth. That could bring the risk of stagflation. We could have higher inflation because of the tariffs. We could have slower growth. Those two things together is stagflation. Our U.S. companies are now exposed to the rest of the world. What is going to be the response around the world and yet they're still priced in for outperformance. And as we'll see later, they're not currently outperforming. And if they're priced for outperformance and they're not going to outperform, then the prices are going to have to adjust and come down. And in addition to that, if the U.S. is no longer seen as this reliable and trade and security partner, that could threaten some of the inflows into the U.S. It could even cause some of the capital that has been invested to leave the U.S. So these are some risks that we are facing that we need to be aware of, we need to consider. We need to continue to think about what are the changes that we could see in the future. But are the tariffs causing a recession here in 2025? And at the moment, they're not. Right now, the key economic indicators are not pointing to recession. In fact, some of them are higher than they were a year ago, doing better than they were a year ago. And so we'll just have to continue to watch this, because there is always a time lag from an event, an economic event, to it flowing through to the full impact on the economy. So the tariffs were announced. If they're going to stick, there's going to be some time lag for that to work through and actually impact companies' net cash flow and what consumers are spending. So I'm not saying that we won't have a recession. I'm saying that right now we're not seeing one, and it's something that we continue to watch. As of right now, the GDP is for this quarter is still at that low a little more than 2%. It started at that. It dropped with the first economic reading of the month, but then as additional economic readings came in, it was increased back up, and it's now at 2.4% through the first 9 economic readings in May. So that is a positive. On the other hand, we see that global yields around the world are increasing. Now, the bond market wants to know that it can have a certain rate of return in a certain inflation environment, in a certain level of risk, that in a certain economic environment, because the bond market is pricing in the risk of default, the risk of higher inflation, the risk of all of these different risks. And if there is more risk on the horizon, then the bond market wants to have a higher return to compensate for that higher risk. And yields go up, prices go down. And so the bond market is sending a signal around the globe that there is some concern over global recession, global inflation. Some of these other countries are seeing a much higher change in their yields year to date than we are here in the U.S. And our yields are higher than they had been for a very long time. And they're stuck at that higher rate for now. So we want to keep an eye on that as we go forward. One of the risks, of course, is that our companies are just not going to be able to earn as much as they had earned. And this is something that's been talked about, I'm sure, quite a bit. But this chart shows us what is happening with the expected earnings growth as companies are adjusting to the potential for the impact on their sector, on their firm. And what we see is that on average, the S&P 500 has gone from an expected earnings growth of 8.9%. That was on March 31st. You see that in the third column. And it's now at 4.8%. So that's almost half. The reduction in expected earnings growth has been cut almost in half as of this point in time. And this was updated last week sometime. Some sectors have had a much smaller impact. They're on the left-hand side of the S&P 500 column. A lot of sectors have had a bigger reduction in expected earnings growth on the right-hand side of the S&P 500 column. And some have even gone from a positive expected growth to a negative expected growth. And so this is telling us that the tariffs, if they stick, are going to play out in a manner that companies are not going to have as much earnings growth. That will then trickle down to the way that companies are priced. But earnings do fluctuate significantly over short time frames. And we see this going all the way back to 1880, that there have been periods where there's been big fluctuation, periods where there have been smaller fluctuation, but there is always fluctuation in the earnings over time. And yet, over a long period of time, the stock market continues to be positive. And looking at this chart, it tells us what percentage of time the S&P 500 has been positive over these various time horizons. 6 years and beyond, we see that the S&P 500 is positive more than 90% of the time. Less than 6 years, then it's less than 90% of the time that the S&P 500 is positive. The shorter the time frame, the less often it's positive, the lower the percentage of time that it's positive. So we have a lot more fluctuation in those short-term periods, but as that time frame lengthens out, then it becomes more likely to be positive. This is why you want to have that 5-year short-term bucket for your cash flow, for your 5-year cash flow. That gives you that runway to let the market do what it's going to do and still have your cash flow protected for that 5-year period. Now, before we wrap up with what you should focus on now, I want to point out what is going on around the globe that is so very different than it has been recently. This is looking at the country performance year to date. The U.S. is slightly down, but most other countries are up, some of them up very nicely. And this is very different than what it was for the last decade. What we can see is that over the last decade, the U.S. significantly outperformed every country on this chart except for one. And so we're in a different time period. This would be a period of time to consider adding international stocks to your portfolio, thinking about where you have some money invested. Things can change quickly. So you want to consider how much risk you want to take, but having some international could improve your returns. So where should you focus right now? If you're planning to retire in the next 5 years, or you're already retired, then you want to review your 5-year cash flow, know what that number is, what do you need to cover the next 5 years of cash flow, and make sure you have the right amount in that short-term bucket and the right amount in the long-term bucket. And then make sure that the money that you've invested is at that right amount of risk for your situation. How much risk do you need to take in order to achieve your goals and be able to meet your cash flow for the rest of your retirement? Once you have looked at that, make sure you've got that mix right, then also think about ways that you can either hedge the risk that you have or limit your downside. There are different assets that you can add to hedge risk. Those will have different hedging qualities. So you want to make sure that you're thinking about the assets that are going to actually hedge the risk that you have for the time frame that you have, or think about some assets that can limit that downside, that would have some buffers or some floors or some ways to protect some of your principal. So think through what could improve your situation, give you the right amount of risk, have you invested for your retirement plan so that you are on your best path in your retirement. And with that, I want to say thank you for listening. If you have any questions, if you're not sure that you're where you need to be as far as your portfolio, your retirement plan, send me an email. I'm happy to answer questions, and I look forward to talking to you next time.